So the personal income tax will be looking at. Please kindly mute your mic, please. Kindly mute your mic. For personal income tax, we'll be looking at personal income tax of individuals in a contract of employment. We'll be looking at personal income tax of sole proprietorship, that is a sole trader in a sole proprietorship business. We'll be looking at personal income tax of partners in a partnership business, personal income tax of estate trust and settlement, and personal income tax of non-resident individual. Now, personal income tax is governed by the Personal Income Tax Act, Cap P8 LFN 2004. And just like you know, two we have two basic taxpayer, which is we have two taxpayer, which is we have two basic taxpayer, which is individuals and corporate bodies. So while corporate bodies are subjected to company income tax, personal individuals are subjected to personal income tax. So personal income tax is like the main tax, that we are to pay on, is like the main tax individual pays on their income. Now, when we talk of personal income tax of, before we go to personal income tax of individual in contract of employment, I'd like to clarify that, okay, in taxation of individuals, we need to first understand that what's it called? We need to first understand what we call residency rule. Why is residency rule important? Residency rule is important in the case of individual, the same way it is important for business. But why we did not really take cognizance of it in the case of businesses? Businesses that will be assessed to tax are basically businesses, though all businesses will be assessed to tax so far they make income from Nigeria. However, for individuals, we need to know where is their place of residence, because the residency rule governs taxation. Now, what do we mean by place of residence? Place of residence is where an individual uses for their domestic activities on a relevant day, aside any hotel or any rest house or any place where they are temporarily staying. That's what we call place of residence. It is where an individual carry out their domestic activities. It is where an individual carry out their domestic activities. Now, for individuals, their place of residence is very important to determine where their to determine where their what's it called? To determine where their relevant tax authority will be. What do I mean by that? For any company now that operates in Nigeria, either incorporated in Nigeria or not, whatever taxes they want to pay, they are all paying to Federal Inland Revenue Service. Whichever part of Nigeria you operate, you are all paying to Federal Inland Revenue Service. But in the case of individuals, we pay to the State Internal Revenue Service of the individual place of residence. So, and before we can say someone is a resident individual, the person must have spent at least 183 days in the country for that year we are assessing. What do we mean? Not at stretch, or not consecutively, but cumulatively, he must have spent at least 183 days. So the fact that someone stayed in Nigeria for 9 months and moved to another country does not make them non-residents for that year. If the number of days you stayed in Nigeria in a particular year is 183 days and above, then you are deemed to be resident in Nigeria for that year, and necessary taxes will be paid in Nigeria. Necessary taxes will be paid in Nigeria. Okay? Now, it is also possible that some individuals will have more than one place of residence. That is, they may be residing here, they may be staying in one place and be working in another place, or have more than one house. Some people have more than one house, especially for security reasons. You may be staying in 3, 4 different houses because you don't want people to come and kidnap you. So if that is the case, then what we now need to determine what we call the principal place of residence. Principal place of residence. First thing first, like I said, the place of residence of an individual is where they carry out their domestic activity. So if an individual is staying in, let's say, especially for people that work in Lagos, majority though, or let me say, some people don't stay in Lagos, even though they are working in Lagos. You see people coming all the way from Agbado, Mowe, and the likes every day, coming to Lagos, especially Island, to work. The fact that they are working in Lagos does not make them residents in Lagos. What will be their place of residence will be where they carry out their domestic activity, which in this case will be what? Their house. So that will be in Ogun State. So in that kind of case, that individual is what? That individual place of residence is Ogun State, because that is where their house is. That is where they carry out their domestic activities. But where an individual now has more than one place of residence, maybe an individual maybe as an individual now, you stay in two different places. You have house in two different places. The one that is closer to the workplace is what we take to be the principal place of residence, because we believe that is what? We believe that is where you reside to the most. Let's assume now you work in Lagos, but you have a house in Lagos and you have another house in Ogun State, and maybe you have another house in Osun State. You will agree with me that such person will stay more in Lagos than any of the other two places, because it is closer to their place of work and they will want to easily get to their place of work. Right or right?
Yes, very correct, sir.
Yes.
So that's your place of residence. So, but if the individual is non-resident, if they are not residing in Nigeria, but they have the only income they have in Nigeria is pension income. If the only income they have in Nigeria is pension income, then their place of residence will be that place they usually reside if they are in Nigeria. Where they usually stay when they are in Nigeria is where will be their place of residence. But if they have other end income aside pension in Nigeria, it will be the place that is nearest to their usual place of work. The place that is nearest to their usual place of work. If they have other unearned income in Nigeria, if what they have in Nigeria is unearned income, I mean, aside pension, they have unearned income. What they have is unearned income. Maybe income, I'll still explain unearned income. Then it will be that place they usually reside. But where it is for an individual that works in a branch or operational site, then the place where the branch or the operational site is located is where we deem to be their place of residence. It is important to know that some individuals don't pay personal income tax to State Internal Revenue Service. They pay to Federal Inland Revenue Service. Individuals like the Nigerian Army, members of the Nigerian Army, they don't pay. I think diplomats also, they don't pay to SIRS, the State Internal Revenue Service. Rather, they pay to Federal Inland Revenue Service. Now, coming back to personal income tax of individual in a contract of employment, you first need to understand what is a contract of employment, what is a contract for employment. In contracts for employment, a relationship exists between the employer and employee, in which the employer assigns the works to be done to the employee and provides the resources with which the employee will carry out such tasks. And also explain to them okay. But in the case of contracts for employment, the relationship that exists is basically that of principal and agent. And the employer does not provide the resources for the employee, for the agent to do their work. What do we mean? Maybe for most of us now that have all this white collar job, I work as accountant in a company, I work as manager, I work as inventory person, I work as this, I work as that. We are in a contract of employment. It is our employer that will provide the building, which we will be calling office. It is an employer that will provide the laptop we need to work, and so on and so forth. But in a contract for employment, it is more like when the employer give out their work, contract out their work. Maybe employer wants to take, for instance, now audit. You want to do audit. You now employ the services of an auditor. You as the employer, or you as the contractee will not be the one to provide them with the system they will use to work or the resources. All you need to do is tell them what you want and they should get it ready. Do we understand?
Yes.
Okay. That is that. Now, that's for the difference between contract of employment and contract for employment. Contract of employment, this still exists. What is it called? Employer-employee relationship exists in contract of employment. But in contract for employment, employer-employee relationship does not exist. What exists is more like what is it called? Principal and agent relationship. Or I don't know if I will even call it, but it's more like a professional, it's more like rendering a professional service where the other party is not an employee. Rather, they can make their own decision. That is just that. Now, the one we are talking about here, the one we want to look at how it is assessed, is contract of employment. For those in contract for employment, it will most likely be either a sole proprietorship business or a partnership business, and if it is a company, then it will be subjected to company income tax. Are we getting it?
Yes, sir.
Yes.
Okay. So now, before we go to the next this thing, which is contract computation of personal income tax in a contract for employment. What are the so first thing, if we want to assess an individual in contract of employment, we start with their income. We basically have two types of income or two sources of income, which is earned income and unearned income. What are earned income? Earned income are those income we derive from our active participation in the activity, from our active participation in generating it. An example of earned income is salary and our allowances. Salary and allowances will only be gotten if you work. If you don't work, you don't get salary and allowances. If you don't work, you don't get salary and allowances. That's for earned income. And any earned income, be it those gotten from trade, profession, vocation, or employment, is fully taxable. It is what? Fully taxable. That is, we tax whatever amount, please, that person should know their mind. Whatever amount we collect or we receive as earned income is what will be subjected to tax. Then fully, it will be subjected to tax fully. Basic salary, any amount they are paying, be it 1 naira or 1 billion, to be subjected to tax. Housing allowance, transport allowance. So all of those ones are fully subjected to tax. For pension, pension is not subjected to tax. Pension income is not subjected to tax. Rather, we'll take it out as non-taxable income. We'll take it out as non-taxable income. Now, aside, bonuses and commission. Bonuses and commission. For bonuses and commission, they are taxed when they are received, not when they are due. What do we mean by that? An employee has worked in year 2024. Then you now say, okay, for the work well done in 2024, you give them 10% bonus, or you give them 100,000 naira bonus. Even if you make that declaration in 2024, it is not subjected to tax in 2024. But if you now receive the money in 2025, then that money becomes taxable in that same 2025 you received it. In that same 2025, you received it. That is that for bonus. We subject it to tax when received, not when it is earned or when it becomes due. Then what's the next one? We have what we call benefit in kind. What is benefit in kind? Benefit in kind are those other enjoyment or those other emoluments that we receive or enjoy as a result of our employment with the company, and it is common for senior staff. So you see some companies maybe buy car for their staff, rent house for their staff, or provide them with domestic staffs and the likes. They are what they are referred to as benefits in kind. And for that benefit in kind, what do we do? We look at how do we treat each of it. Benefit in kind will be subjected to tax in the hands of whoever or the employee that is receiving it. However, depending on the type of benefit in kind it is, we determine how we treat it. 1 minute, please. Okay, so as I was saying, for the benefit in kind, we have one, accommodation. Where an employer provides the employee with accommodation, we call it a benefit in kind. And for that benefit in kind, it will be subjected to tax in the hands of the employer, in the hands of the employee. What do we mean by that? We believe that for the employer to provide you with accommodation, it is still part of your emolument for the job you are doing. So the house they are giving you is actually not for free. Rather, they factored it into the salary they are supposed to pay you. So for accommodation, we look at if we have rateable value, we take the rateable value. Rateable value is what the local government authority would have charged as rent for that building or for that accommodation. If we have rateable value, we choose the rateable value. If we don't have, then if there is no rateable value, if the building is rented, we use the rent. Okay, we don't have the if we have the rateable value, we go for that first. If we don't have that, we go for what's it called, the rent amount. If we don't have the rent amount, then we go for 5% of the cost or market value. If the building is, then 5% of the cost of market value is what will be deemed to be the benefit that has been enjoyed by the person. So that is that. So for official car, if the car is rented or hired, whatever amount they are paying for the rent or the hire is what will be taken as income in the hands of the employee. But if it is owned by the company, then 5% of the cost or market value is what will take to be the income. We can also have other assets. Maybe employer help the employee to furnish their building or buy any asset for them, maybe free and the likes. If it is rented, whatever amount they are paying for rent, if it is owned by the company, 5% of cost or market value. And we can also have domestic staff, where what the company provided to the employee is domestic staff. Then the whatever they are paying to the domestic staff as salary is what will be deemed to be taxable in the hands of that employee. That's what will be deemed to be the income of that employee. That's that. Now, however, all these benefits in kind we are talking about, if the employee had to pay for a portion, let's assume now the employer has rented an apartment for the employee and the apartment costs 600,000, but they will be taking 200,000 out of the employee's salary. That means the benefit you will actually be enjoying is just 400,000. It is that 400,000 you will take as its benefit kind, not the 600,000. Are we getting it? You do 600,000 minus 600,000 each good thing. So if the employee is contributing to the benefits in kind, the portion the employee is contributing cannot be taken as the benefits in kind. And also, we need to prorate it where they did not enjoy it for the whole year. Maybe they only enjoyed it, maybe they joined the employment in, let's say, May now. May to December is just 8 months. You can't calculate benefits in kind of 1 year. You calculate for the 8 months. That's for benefits in kind. Then we have unearned income. What are unearned income? Unearned income are those income that arises as a result of previous accumulation of wealth. What do we mean by that? As we are working, people will be telling you, save, save, save. And when you save, they'll tell you invest, invest, invest. When you invest, they'll tell you to use the money to get assets. So what we get, the income we make from those our savings, the income we make from those our savings or from the investment we have made is what we call unearned income. So what are the types of unearned income we have? We have things like what? Rent, interest, royalty, dividend. Rent, interest, royalty, dividend. And unearned income are assessed to tax on preceding year basis. That is very important. But earned income, which is income from contract of employment, income from contract of employment, are assessed to tax on actual year basis. Now, for the unearned income, in some cases, they do come net of withholding tax. That is, they can tell you that, oh, this rent figure is the net. For the purpose of our computation, we will have to gross it back. We need to use the gross amount. So what do? We'll divide whatever figure we are given by 0.9 because the withholding tax rate is 10%. 10%. Okay? That's for unearned income. Now, after getting the total earned income and total unearned income, that will give us total income. Then we left what we call tax exempt. What are tax exempt? Tax exempt are those income. Tax exempt are those expenses that are what? That are allowable to be removed. They are those expenses that are allowable. That are allowable to be removed from what? From the income before we subject the balance to tax. Okay? Now, what do I want to say? For the tax exempt, we have tax exempt like one, pension fund contribution. Any contribution we are making to pension fund, you know, currently in Nigeria, what do? We operate a contributory pension scheme. We operate a contributing pension scheme where both the employer and the employee must contribute a certain percentage to a pension, which will be the benefit of the employee after retirement. So in Nigeria, what we do currently, what the law mandates, the National Pension, the Pension Commission, the PENCOM Act, what is obtainable there currently is 18%. An employee must contribute 8% of their of their basic salary, housing allowance, and transport allowance to the pension scheme, while an employer must contribute 10% of the same value, 10% of the basic salary, housing allowance, and transport allowance of the employee. They must contribute 10% of it to the scheme. However, voluntary contribution is allowed, and any voluntary contribution also is exempted. Provided the fund you are contributing to is approved by the Joint Tax Board. The next one is gratuity. Gratuity is when how will I explain it? Okay, gratuity is the lump sum that is paid to an employee that has worked in an organization for a while. Maybe some organization pays gratuity to you after you've worked there for 5 years, some after 10 years, and so on. But whatever amount you are paid as gratuity, it should be part of your earned income. But at the same time, you take it out as a tax exempt. It should not be subjected to tax. Contribution to National Life Assurance Premium. If an individual takes an insurance policy on their life assurance, so then whatever they are paying as premium to that scheme will be what? Will be allowable for tax, will be a tax exempt. Whatever they are paying as premium for the tax will be for the whatever they are paying as premium for the life assurance will be allowable. However, the premium we are talking about is premium on the assurance of their whole life and their spouse life. That is, you can insure yourself and also insure your wife or your husband. But aside that, any other premium you are paying will not be allowable. That is, if you go and insure your children now, it will not be the premium will not be allowable. It will not be a tax exempt. Why? Or let me just say, generally, it is children that have insurable interest in their parents, because when parents dies, is a financial loss to the children. Die is a financial loss to the children. But where children should die is a financial relief to the parents. So parent doesn't even have insurable interest in their
children's demise.
So insurance premium paid on the life assurance of an individual and their spouse is allowable. The next one is what? National Health Insurance Scheme. Contribution to National Health Insurance Scheme is allowable, and the contribution is usually calculated at 5% of the basic salary. 5% of basic salary. For contribution to National Housing Fund, it is calculated at 2.5% of basic salary, and that one is to enable individual get houses. So with this contribution, you can get mortgage loan and get a building or an apartment. Okay? Having done all of the tax exempt, if we have found investment income, we also take care of it. Then we go to what we call consolidated relief allowance. Consolidated relief allowance is just a portion of the income that is not to be what? That is not to be subjected to tax, and it is calculated at A, higher of 200,000 or 1% of gross income. We look at 200,000, a constant amount, and 1% of gross income, whichever is higher. We add it to 20% of the gross income. And with that, we get consolidated relief allowance. And once we deduct consolidated relief allowance from our gross income, what we have is chargeable income, which we will now subject to tax based on the based on the um based on the tax rate that we have. So without wasting much of our time, you can go through the material later. Let's look at question 1. Who is reading?
Odunola is an employee of a company in e-financial service in Lagos, Nigeria. The following is the income that accrued to her in 2013 tax year. All whatever seems to be correct. 1. She has 3 children and aged mother of 15, 13, and 10 years old. 2. She pays 120,000 annual premium on her life assurance policy. 3. He contributes 2.5% of his basic salary to the National Housing Fund contribution and 7.5% of his monthly emoluments to the contributory pension scheme. 4. He received investment income as net of withholding tax as follows. Required. Compute the chargeable income of Odunola for 2013 year of assessment. 2. Compute the tax payable for 2013 year of assessment.
So to do this, we have personal income tax of employees. So the first question, we are looking at Odunola. We are asked to compute computation of tax payable for 2013 year of assessment. In case we are not being told, we look for the current year. The year salary income is being given for is what will be our year of assessment. So we start with the end income. So what are the end income? Salary, 1.2 million. Housing allowance,
900.
900,000. Transport allowance,
300,000.
leave allowance,
100.
the meal subsidy. So what do we have as the summation for the total end income? Hello?
Hello, sir.
What do we have
We
as
have
summation for total lending?
2,720,000.
$2 million
720.
720.
So for the unearned income, we were told that he's receiving investment income net of withholding tax as follows. Since we are assessing for 2013 and we are told us that unearned income is assessed on preceding year basis, that means we'll be picking the ones of what? 2012. 2012. So we'll have rent. And we are told he received those figure net of withholding tax. So that will be 675,000 divided by 0.9. Then dividend will be what? 250,000 divided by
0.09.
no 0.09 is 9%. So what we are doing is 90%.
90.
750.
Huh?
750.
Okay. Sorry. So, sorry, what do you call the first one? 750, Abby? The second one?
750.
The second one?
277, 778.
277,778.
Yes.
So that will give us a total of how much?
13055.
One what?
102.
Sorry, mistake.
102.
102,
7778.
778.
Yes.
So with that, what will be the total income? Total income for this person will be how much?
That is 3947.
3947
778.
778. Then we less tax exempt. What will be the tax exempt? Our tax exempt should now be what? We'll have one. They said she pays 120,000 annual premium on a life assurance policy. Life assurance premium 120,000. Then they said it contributes 2.5% of basic salary to National Housing Fund. National Housing Fund. 2.5% of basic salary. That's 2.5% of 1.2 million. Then they said it contributes 7.5% Can that person mute, please? So monthly emolument as defined in the Pension Reform Act, that will be the basic salary, the housing allowance, and the transport allowance. So that will give us how much?
The first one, basic salary, 30,000. The National Housing Fund. National Housing Fund, 30,000.
30,000. What about the pension?
And
You first
70.
add those money together, 1.2 million plus 900 plus 300. Then you add it times 7.5.
That is 292 times whatever. That is 219,000, if I'm not mistaken.
200 and what do you say?
I got 200, I be 2 million. Abi?
It cannot be 2 million. No. If you do 1.2 million plus 900 plus 300, that will give you 2.4 million. Then
2.4.
multiply by 7.5%. That should be 180,000. So all of that will give us what? 330,000, Abi?
Yes.
Then we will also less what we call frank investment income. I think I've explained frank investment income when we were doing this in Abi, when we're doing company income tax. There are those income that the withholding tax charge on it is deemed to be the final tax. After withholding tax, we don't charge any other tax on it. Is it clear?
Frank.
Hmm? Okay. So frank investment income here will be dividend. The dividend should no longer be subjected to any tax because it has been subjected to withholding tax. So if that is the case, after taking out that, what do we have as the gross income? What do we have as the gross income?
$3,340,000.
343 what?
3,340,000.
3,340,000. Okay. Then we less consolidated relief allowance. So our consolidated relief allowance will be higher of 200,000 or 1% of gross income. So obviously 1% here will just be 33,400. So 200,000 is higher. We'll pick 200,000. Then plus 20% of gross income. That will be what? 20% of 3,340,000. And that will give us how much?
$668,000.
658,000.
68, 600, 668, 668.
So that will give us what? 8.
668.
Wait, we've made mistake with this thing now. First thing first, the figure here is 2,720,000.
2,720,000.
We had that 2,720 to 1,027,778. That will give us 3,747.
Yeah.
778. So if we now do that and we deduct all of this, what do we have? That should be 3,140,000. So I think the person that gave me that earlier figure thought what I wrote there is 7. It was 9 instead of 7.
I thought
So
it was
20% of 3,140 is what?
No, that's total for total income is correct. Okay, it's 2,720.
720.
Yes. So with this, what is our chargeable income? Figure.
Chargeable income 2,312,000. 2,312,000.
What is 2 million?
312,000.
Okay. So then we will now do the tax liability. Tax liability will be, so the tax liability is a graduated rate of first 300,000 at 7%, 21,000. Then the next 300,000 at 11%, 33,000. That is 600 out of 2.3 is still remaining 1.7. So we can do the next 500 at 15%. That's 75,000. That's a total of 1.1 million. We still have 1. Next 500 at 19%. That's 95,000. That's 1.6 million. It's remaining 712. So we'll say the next 712,000 at 21%. What would that give us?
$149,520. 149,520.
149,520. So what does it give us in total?
Total 373,520. 73,520.
3 what?
373,520.
373. That's the tax liability. But we'll now less the withholding tax on rent. You know, but we use the full value of Abi. So less withholding tax on rent, which is 10% of the 750,000. And that's how much? 75,000. What will be the tax payable?
Tax payable is 298,520.
298
520.
520.
Okay, then.
Okay, so that. Can we look at question 2? Hello,
We are here, sir. I'm here, sir. We are here.
Mr.
question 2, who is
Godwin,
reading?
okay. Mr. Godwin
So,
is the director.
the Federal Ministry of Oil, Mining and Resources on 31st December 2012. On retirement, he was paid a gratuity of 3 million. On 1st January 2013, he secured an employment with OOU Limited, the manufacturer of milk products for the hearing impaired individuals, on a salary of 7.2 per annum. Mr. Godwin is married with two wives and 5 children. The following information was also provided at the end of his first year in his new employment. The eldest son, Buchi, is gainfully employed with a Tom Tom Bank Limited. The company B. The company provides Mr. Godwin with official car with market value of 3.5 million. C. The company pays 720 per annum on his official accommodation. D. Mr. Godwin has a life assurance policy with Aiko Assurance PLC. The sum assured of 5 million while premium paid is 50,000 per month. E. He contributed 15,000 monthly to an approved pension scheme. F. He spent 15,000 during the year for the upkeep of his two aged parents who have no source of income. You are required to compute Mr. Godwin monthly and annual tax liability for the relevant year of assessment. Full stop.
Okay, so we have Mr. Godwin, computation of tax liabilities for the relevant year of assessment here will be what? 2013, because the
Okay.
information we're giving is for 2013 year of assessment.
Yes.
The job he has with Tom Tom Bank, the job he has, the new job he secured with OU Limited was in 2013.
Yes.
Okay. We have um, end income.
Salary.
So first thing first, we're told that what?
Salary. Yeah.
He had salary of 7.2 million,
Two
abi?
point.
Yes.
Yeah.
Seven.
So since he started the employment on 1st January, we'll take the whole salary. But if he had started late after 1st January, we would have need to prorate the salary because the salary is 7.2 million per annum. But aside that, the company provides him with official car with a market value of this. So we'll say benefit in kind. For the official car, for them to say the market value, that means it's owned by the company. So we'll say 5% of the market value, 3.5 million. How much is that?
That is 1,750,000. I mean 175. Sorry, 175.
175,000, I
175.
mean.
Yes.
Then official accommodation. They told us what?
Okay, 720,000.
They told us the company is paying 720,000 per annum on it. So official accommodation 720,000. And I think that is all. So then he received a gratuity of how much? 3 million.
3 million.
Aside all of this, they did not tell us he earns any other unearned income. So that will be the same thing as his total income. So what will be the total income?
Total income 11,095,000.
Sorry, sir. 3 million for gratuity. I said the 3 million for gratuity.
This is it. Have you seen it?
Yeah. Okay.
11,095,000.
Okay. 11,095,000. Then with less tax exempts. Oh, what are the tax exempts? The tax exempts are what? We have life assurance premium. Is paying a premium of 50,000 per month. This 5 million is sum assured. That's not what we are concerned with. We are concerned with the premium. Life assurance premium, 50,000 per month times 12. That will be how much?
That's
600,000. I mean,
yeah.
pension, the fund is contributing 15,000 monthly. So 15,000 times 12, what?
180,000.
180,000. Then I think those are the two we have. So if that's all, that will be how much? 780,000. So if we less this, what do we have as the gross income? Because we don't have any frank investment income here.
Balance 10,315,000. $10,315,000.
10,000,000,
315,000.
315,000. So with less consolidated relief allowance, Abi.
Yes, you are right.
Okay, that will be higher of 200,000 or 1% of gross income. And that will be what? That will still be 200,000 because 1% of gross income will be 103,150. So 20% of gross income, that will be 20% of 10,315,000. That will give us how much?
1,315 and 31,500.
Sorry, what do you call it?
1,31,500. No,
No,
sorry, no. No.
you are
I
doing
did
20.
20%. 2,063,000.
Sorry. We've made a gross mistake. Don't forget the the gratuity is part of the tax exempt. Is that not it?
Gratuity. But
Gratuity.
we've added this back
Gratuity
to
there.
Abi.
It's an income, but at the same time, is to be exempted from tax. Gratuity, 3 million.
Wait,
Remember, it is one of those things we have here. Gratuity. I told us it's one of the tax exempts. See, tax exempt, pension, gratuity, life assurance, national health, national house. Is it clear now?
okay.
Yes, it
Yes.
is.
We add it to get the total income, but we'll also deduct it back to get the gross income. So that means this should have been 3,780,000. So what do we have?
That's 7,315,000.
Okay, 7 million
315,000.
315,000.
Yes, sir.
That's the gross income. Then we less consolidated relief allowance, which is higher of 300,000 at 200,000 or 1% of gross income. That's 200,000
Yeah.
plus 20% of gross income. That will be 20% of 7,315,000. And that will give us how much?
1,463,000.
Three. Okay.
1,4.
63,000.
16,000.
So what do we have in total? That should be 1,663.
63,000.
So what's the chargeable income?
5,652,000. 5,652,000.
5,650,000.
652. Yes.
So the tax liability will just be first 300,000 at 7% will be
From next year is when we are going to start using the new tax
21,000.
liability.
Yes. At 11%, 33,000. Next 500,000 at 15%,
17%.
75,000. Next 500,000 at 19%, 95,000. Then the next 1.6 million at 21%, 336,000, and that's a total of 3.2. So that will be 2,452,000 at 24%. And what would that give us?
That is 588,480.
10,000.
588,480.
Okay, so please, I want to ask a
588,480.
question.
So
In the
what's
first,
this?
sorry, I want to draw us back before. Hold on, please. I remember the first example we did. After the next 500,000 at 19%, the
Yes.
next one we did was next at that's 712,000 at 21. So why is
Yes.
this one having 1.6 million at 21%?
Okay. So because in this in the tax band is this first 300,000 at 7%, the next 300,000 at 11%, the next 500,000 at 15%, next 500,000 at 19%, next 1.6 million at 21%, and the last and anything above the 3.2 million at 24%. So what does that mean? In the first one, we stopped at 21% because after assessing 300, 300, 500, 500, that's a total of 1.6 million. If you take out 1.6 million here, is remaining 712. And the band at this point is 1.6 million. It's not up to the figure we have left is not up to the 1.6 million.
Okay.
But in this case, because this one is more than, that's why we
Still
give
have
1
it.
million and still move to the next stage.
Okay, okay. I understand now. Thank you.
1,148,480. Tax liability.
1 million.
148,480.
So that's the annual tax liability. And if we are to calculate the monthly tax liability, it will be what? 1,148,480 divided by 12. And that will give us how much?
95,706,707.
95,707. So that is that.
Bravo.
Are we doing one more question?
No, sir. No, sir.
Why no? All right, no problem. Let's have a good night rest. We meet in the next class.
Mr. Atunji,
Hello,
please
sir.
talk.
Are you going to
Let
help?
us continue. Okay.
No,
Oh,
I
yeah, go
want to ask something. Are you going to help us send this thing on the platform? Especially the note on the personal income tax. I should help us
I
drop
sent
it.